Hi guys. Oops, sorry. Hi guys. Good morning. Good morning. So I'm going to be talking about deferred tax, and let's just go to the chapter. And really, it starts off talking about taxation. I mean, it just has the general topic taxation. And before we talk about deferred tax, it just briefly does an introduction on current tax. And so I won't say anything yet about deferred tax. I'm just going to talk about current tax and what we know anyway about current tax. So let's just talk about this, right? You and I know already that you have your accounting profits. You will have your accounting profits, and what we'll have is that you would have done, of course, you'd have had your revenue and you would take off all your expenses as far as the standards are concerned. So the standards will tell you what expenses you can deduct, if you like, so A minus B, and you will get your accounting profit. And you and I know that for taxation purposes, some expenses are just not allowed, if you like. So, for example, I don't know, entertainment. That's the one I'll use a lot. Entertainment is just not allowed, if you like, or considered to be an allowable fines, not considered to be allowable expenses, if you like. So, what will happen is when it comes to your tax computation, imagine this was 1,000. If you had deducted, I don't know, 50 regarding entertainment and fines, you would add that 50 back to the 1,000, and you would have 1,050, and you would calculate your taxes based on whatever the Finance Act says the tax rates should be, and that would be 30%, for example, or 20%, or whatever it is. And those are the taxes that you would then send back to the folks, if you like, in accounting, and they would now put through the journal of debit tax, whatever figure you had calculated, if you like, and credit the tax liability, because you will not be paying the tax for this particular year in that year. It's not possible if this is year ending 2019. You're calculating the tax for 2019 to pay, if you like, in 2020. We know that for small companies, taxation is due 9 months and 1 day after the year end. So if this had been the 31st of December 2019, you'd be paying taxes, if you like, on the 1st of October, if you like, 2020. That would be the deadline anyway. You can pay sooner, of course. And so that's the first thing with current taxation that we should know. The other thing, of course, with this, what they do again, is to just sort of explain the double entry here, but it won't be nothing new for you. What the key I want to stress is that what we always recognize in our liability with taxation is what the tax is for that year. I mean, that's the signal. That's what tells us what the tax is actually due for that period. Remember, we're still following the accrual system. What is the tax of 2019? That's the tax that should be in that year in the statement of financial position. Of course, previous years you might have overpaid or underpaid tax, because that's what happens, if you like, because these are all estimations. Profits might change, new things might occur. So just taking you back to the actual textbook to just see the examples they use. I want to use those. Remember, this topic is not really about the current tax. They just introduce this to just sort of get you comfortable with it. In fact, what I will do is I will snippet this out, if you like, very quickly, and snippet this out here. Yeah, and I will just save this. Save as a here we are. This is this capture. Save. Okay, and then let us go to the PowerPoint and let us bring this in here. Insert picture. Stop. Oops, sorry. Nope, not there. Capture. So that's in there now. So this is the picture here that they want us to work around with. But then I'm just going to do this, and then you can see what's going on. Okay, great stuff. So what do I have here? I'll just go home here, and let's just pick this bigger. Okay, yeah. So see if I can get rid of that. Oh, I can't. Okay. Key point here. Simple has estimated its income tax liability for the year 2008 to be 180,000. In the previous year, the liability has been estimated as 150. So let's look at what happened in 2007. This is important. So in 2007, this is what you did. You said that my tax expense, estimated, of course, 150,000, and then you credited tax liability, statement of financial position, of course, under current liabilities, 115,000. So anyone who looks at this will look in the statement of financial position and will see that your tax for the year had been estimated to be 150. Change my pen color. What happens is that in 2008, so this is 2007, of course, right? This is all '07, '07. This all happened '07 in terms of the dates, 2007. So in 2008, what you then do is you pay your taxes, if you like. But you pay your taxes because if you've come to this agreement or you found out later on, actually, if you like, the figures are actually different. So in 2000, remember that what's happened here is that you've transferred this, of course. Remember in 2007, you've transferred this to the income statement. This is done. This happened in that year. It's gone 150,000. It's gone to the income statement. Of course, this got carried down, didn't it, in 2007? This got carried down 150,000 and this got brought down 150,000. So we had an opening liability of 150,000 at the beginning of 2008, didn't we? So what happens, it says that during the year in 2008, you then pay, if you like, you agree, or actually say, listen, guys, we should have paid 165. So no problem. What you do is, yes, of course, we debit the tax liability account. That's the only thing that's really visible now in 2008 with regards to 2007. Yes. So we now debit the tax liability account 165 and we credit the bank account 165,000 because we've paid that. Now we can see we have a difference here, if you like. So the first thing we do with this difference is that we, if you like, we need to sort of start this afresh, so to speak. And so we close this account down by, in effect, sort of saying, well, listen, actually what happened was we should have actually paid more. We thought we were supposed to pay 150, but we should have paid 165. It's not a problem. What we then do, or technically, is we then transfer. We have a balance, if you like, of course, of 15,000, right? So I guess the fast way to do it is to sort of say that the fast way to close this out is to sort of just sort of put 15,000 here, credit this and debit this of 15,000, right? I mean, that way I close this account out, if you like, for the year. And that's how I manage the double entry here. You could have done the carried down 15 and then done all of this and then brought down the 15 and then now transfer it 15 from here to the expense account. The way we deal with every accrual account, at the beginning of every period, what you do is you clear out the accrual back into the income statement and then you start all over again. So I have 15,000 here. So this account, my tax liability account, is now clean. In 2008, it now says that your tax liability is 180,000. So what you now do is, 180. You now debit 180,000 here for your tax expense account, and you credit your tax liability of 180,000. So what you now notice or observe is that your tax expense is showing 195, if you like, for the year, and that's just how we sort of deal with this every single year. And so we now transfer to the income statement 195,000. Right. So this tax expense is just is what sort of we use to make up or recognize the fact that, okay, we're paying taxes from the previous year as well as paying taxes for our year. But we always use the tax liability account to highlight clearly what the taxes due for the year. So for this case, the tax expense would be showing, tax expense would have been showing 195,000 and the tax liability would be clearly showing the 180,000. And I literally do exactly the same thing, but this time you will see that the difference will be, this is recorded so I can clean this screen. So I have exactly the same scenario here where I had 150,000 here, you had your 150,000 here, transfer this to the income statement in 2007, yes, and that's gone. So you have your tax liability of 150, you pay, this time is different. What you end up doing is this time, it says that you, in 2008, what you now agree with HMRC, your taxes are 140, so you now pay 140,000. So when you now pay 140,000 to the bank, out of the bank, sorry, by HMRC, what you now have is a difference of 10,000. So you kind of almost like an advantage, if you like. So what we now do to clear this out, I really could just simply do 10,000 here and then 10,000 back into the income statement, in effect. Or again, I could do my carried down and then do that and then brought down 10,000, and now I can now transfer this from here, 10,000 here into here. The point is, the end point is that all this will get back onto the credit side of my tax expense account. And then what do? I now put through my new journal at the end of the year. Remember, all this happens at the beginning of the year. So the assumption is I'm paying on the first day of the year in 2008 for my taxes for 2007. So on the last day of 2008, I put through the expense of of tax for the year of 180,000, 180,000 here, and you can see that my tax liability is still very clearly 180,000. It's still very much 180,000. Very clearly 180,000. And if you like, as a result, I now have a transfer to my income statement of 170,000. And so this first video really just tackles that very simple procedure of dealing with current taxes. And moving on from here, we will look clearly at deferred tax.